I think the era of Tron is going to end one way or another. I think especially kind of with these kind of now, I think increasingly kind of non-peer-to-peer use cases. I think you just have kind of a very, very large universe of use cases that like Tron just isn't built for.
Nothing said on dYdX Research is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are solely our opinions, not financial advice. Boccaccio, Ryan, and our guests may hold positions in the companies, funds, or projects discussed. What's up, guys? Welcome back to another episode of dYdX Research. Today, I am joined by Paul from Plasma and Zaheer, founder of Split Capital. Thanks for coming on, guys.
Thanks for having us.
Likewise, yeah.
I guess before we get started, do you guys want to give a short introduction? Zaheer, maybe we can start with you and Split Capital, and then we can dive into Plasma more deeply.
Cool, yeah. So I've been the founder of Split Capital now. It's a hedge fund in the digital asset space. It kind of focuses across themes and sectors, and mostly focuses on discretionary investment strategies. And I've been in the space now for about 8 years now. It's kind of crazy to say that out loud. Focusing, from DeFi to more of the philosophical arguments for crypto. I actually met Paul a few years ago, and it's kind of the connection and the introduction to Plasma. So
Cool. Yeah, I used to work at dYdX way back in the day. I was kind of involved on the dYdX research side of things, which is how I met Z initially. Now I think that was probably, I don't know, 5 years ago now or something. I used to play poker way back in the day, and that's kind of how I got into crypto somewhat early on. Then very active on chain, kind of went through really kind of the kind of early genesis period of DeFi. Was pretty active in that kind of across the spectrum there. Then built a company on the institutional side of things called Alloy, building IMS PMS software, and now a bit more on the crypto native side, again in building Plasma.
Fantastic. And I guess what was the idea behind Plasma? Why did you decide on building out a new stablecoin chain?
I think you have this very unique combination of kind of the most massive, most kind of clear TAM market, which is stablecoins, and then infrastructure that like just kind of in a path dependent way kind of ended up being the standard infrastructure, but isn't actually kind of the optimal solution for this. And so I think that this very much comes from like a thought process being like, what do we think stablecoin kind of rails and stablecoin settlement on chain, like what does that look like in a year or two or three? And I think it's going to look vastly different than it does today. I mean, it's basically mostly driven by ETH mainnet and Tron. Those are really the two chains that really matter at scale. I think both have their kind of unique idiosyncratic issues, and I think like neither actually are kind of in a position to like really win this in a massive way going forward. And I think you just have to make somewhat different choices by just being very focused on stablecoins, and that requires like the laser focus on it. Basically, I think there's massive value and definitely kind of a place for generalized chains. Obviously, I think those kind of continue to be like key pieces of kind of base layer infrastructure, but specifically for stablecoins, you just have a lot more kind of creative kind of space you can work in if you make the kind of very clear choice that this is the only thing we're focused on. Like we want to be the best rails for moving stablecoins from A to B, mint redeem, and then asset issuance. Everything else we don't care about. Everything else we can kind of ignore, make trade-offs on, and I think that is massively valuable and not something that anyone has really done. And that's a massive disconnect to, I mean, stablecoins basically didn't really used to matter. If you look at like the pre-2020 era, most of the volume was like non-stablecoin related. And that's changed in a massive way. But like depends on how you measure it, but like more than half of block space consumed is consumed by stablecoins, and a good chunk of that by stablecoin transfers actually. And so this is kind of the one massive PMF that crypto has, and it's not being served as well as it could be. And I think Plasma is very much the answer to that. Sorry, very long monologue, but that's kind of how we get to Plasma in a nutshell.
That makes sense. Zaheer, I kind of want to pull you in here because you have, well, this pod is going to be kind of unique because we have both the technical side, the founder side, as well as we have an investor in the protocol. So what pulled you into Plasma? Why did you say this is a good opportunity and I want to be part of it?
Yeah, it's easy to sometimes, support a friend when they're starting a new endeavor, right? But I think, obviously my stance on plasma is kind of evolved from that to one where it's, very seriously been like the most interesting kind of investment opportunity. But also, more specifically, the most interesting kind of use case for crypto that I've seen in a long time, right? I think this is kind of like, let's say the last like 8 months in particular has really been and more specifically last three in particular has been the stablecoin era, if you will, where I think it's a confluence of things, right? You're kind of ending the crescendo of multiple years of DeFi, and up only kind of, Ponzi-nomics into uh, investors kind of coming out of out of a groove with protocols that don't make money. And then you're also kind of met with at the same time an administration that is actually kind of pro crypto, or rather, very pro crypto. And it's a pretty bipartisan issue at this point. And you're getting the one piece of like core crypto technology that is universally, I'm talking trad, I'm talking, VC tech and crypto, and policy is adored, right? So you're kind of in the right place at the right time more than anything else, in terms of, how you're kind of looking at this whole landscape as an investor. And I think there's a lot of things you can fund that will theoretically make money. But I think what matters more is, well, what happens after a year, 2 years, 5 years of putting, money behind an investment, right? Does it actually have a tangible value, right? And I think, in the 2019 era, when a lot of people were kind of investing into protocols, right? Like a lot of those things did like pretty well actually in reality, only because valuations were pretty cheap and things ran quite hard in 2020 and 2021. But I think, Plasma tends to kind of change this a little bit because it's fundamentally a different approach in terms of what the longevity of a protocol can look like, right? And not taking shorter term wins to at the expense of the long run. And I think that's kind of what differentiates it more than anything. I think knowing Paul and the rest of the team, spending more time with them, and kind of getting to learn more and more about how they think about the product has been probably the most interesting kind of uh, let's just say advancement I've seen in terms of crypto maturity in the last couple of years, which I think is kind of being adopted and seen by the market, right? I think you're seeing this kind of narrative shift also in terms of where people are are actually getting optimistic and bullish on stablecoins, whereas in the past, being bullish on stablecoins meant you're just cashed up because you're just out of the market, right? So it's kind of
That's
a
probably
funny
also a
transition.
component of that, right? But yeah,
No,
I think
yeah, for
it's
sure.
also kind of now, it's also just kind of become substantially more interesting. And I think, I mean, it's so obvious that like stablecoins just have incredible kind of PMF now, and I think especially going forward, right? But like it's still like stablecoins are pretty small. I mean, you're talking about like what 1% of M2 money supply. Like it's not a massive share right now. I mean, 240 billion, a lot of money, but like in the grand scheme of like global commerce, it's not really. And I think we're kind of now in the beginning of kind of really seeing kind of those quote unquote real things coming on chain, and you're seeing on chain kind of commodities trades, right? But like Tether recently did their first kind of oil trade, that was kind of fully settled in USDT, and you're kind of really seeing a lot of those like very, very kind of real financial use cases basically kind of at least kind of start to consider settling on stablecoin rails, and I think that only accelerates, and I think that is kind of the one mega trend that's going to continue happening, where you just see more and more actual commercial activity be settled in basically digital USD.
I want to get a bit into that because I feel like most people, when they think of stablecoins, they think it's just payments, which is a very good PMF, especially for some countries. And like being able to hold the dollar is fantastic, especially in some countries. But curious how you're specifically thinking about what that PMF will evolve into becoming, and if there's anything that people are not thinking about that isn't like very clear to the average person.
I think you kind of have different categories, right? I think payments are obviously massive. But I mean, kind of by definition, I mean, global payments volume is larger than global GDP, and so like, whenever you like, you can just like make up incredible sounding numbers and can kind of make them work basically in terms of TAM, and I think you're kind of seeing a lot of different angles in terms of like where stablecoins are going to be integrated in those stacks. And I think that is true on the consumer side of things, right? Especially internationally in terms of remittances and kind of international kind of payment flow. I think that's a large component. Then you do have kind of the commodities, B2B, especially with high friction jurisdictions where like it's just very, very annoying, expensive, and slow to kind of engage with traditional banking rails. And I think that's kind of a massive component. Obviously, I think you just have basically we've invented a kind of better, faster, cheaper way to move value globally, and I think that is it's very obviously better than kind of the legacy system. And I think like things like this always take more time than you think. Well, like I think it's pretty small now, and I think it's going to like grow massively. It probably takes some time to like actually kind of take meaningful share from kind of real kind of non-stablecoin denominated payments flow. But I think it's inevitable that it happens in basically every category. And then so I think kind of really the future state of the world is basically going to be that the El Salvadorian farmer interacts with stablecoins, and so does the hedge fund in Dubai, and so does the multinational shipping conglomerate that kind of moves oil or gold or palladium from the Netherlands to Zimbabwe. I think all of that, like those are massively different use cases, obviously, right? And like a massive kind of spread between all of those. I think the end state is all of them are going to touch stablecoins in some capacity.
Yeah, I think, to add to that, you're also seeing this kind of uh in terms of product decision making as well, right? Where now the question really gets asked, right? Like, well, we have 50 different kinds of stablecoins, and I'm jumping the gun a bit here, and I think because it's probably one of the questions you'll kind of get to, but you get to the point also of, well, why do you even have so many stablecoins, or why do you even have so many different kind of actors, right? And I think, to answer your question, to go from like payments up here, right, and then, why is this the only focus that we have today? I think, when I hear this from the Plasma team more than anything else, it really goes from, okay, today, between ETH and Tron, payments are generally understood in the stablecoin landscape. But what happens when you start looking at every other part of the stack, right? And you say like, it's no longer peer-to-peer payments, or like, me sending money to my family. It's more so every piece of commerce that like can be done digitally, right? That doesn't need to, use some sort of, you know, Fedwire, or ACH, or similar kind of banking rail, right? So I think that's kind of the longer game that you know the Plasma kind of vision focuses on, right? It's not so much the only the focus of let's figure out the Tron Ether payment network and get to that day one, but it's instead the longer tail kind of what are all the downstream implications of a stablecoin based economy.
I think that makes sense. I want to take a step back and, Paul, give you the chance to explain kind of the tech stack and the architecture of Plasma.
Sure. No, I'm happy to do that. It's basically, I mean, the approach we've taken is basically like what would a chain kind of need to look like to be like the perfect product for stablecoins, and that involves a couple kind of different aspects, basically, where on one hand, fast and cheap is kind of a given. I don't think anyone wins on fast and cheap. I think it's just kind of table stakes to have a chance, basically. And so I think that's actually not terribly interesting, because I mean everyone has to be fast and cheap, otherwise you have kind of no way of kind of even being in the arena, and but then you can do quite a bit, on the kind of actual kind of protocol level feature set that kind of enables just better stablecoin functionality, basically. And for us, I mean, Plasma, we've kind of built our own consensus, that is fast hot stuff, and PFT based, and have full EVM compatibility. There's likely going to be a layer on top, but TBD, and that is critical, to kind of be very easy to integrate, wherever, like payments is an integrations business, the way I view it. And so like anything you can do to make it easier to kind of integrate with existing infrastructure, existing payment providers, all of that is critical. But to kind of get back to like why is Plasma unique, and kind of like how do we differentiate from basically just any other fast EVM chain? Because there's plenty, right? I mean, you have like a very long list of fast and cheap EVM chains, and some of them are great, some of them are like not. Like, I think the interesting part is like what's the kind of delta between just a plain vanilla ref, fork, and what we do at Plasma. On one end, we have zero fee transfers, at scale, and so we don't need to subsidize transactions, and we have kind of sound resistance, through some relatively complicated mechanisms. So you can actually move USDT, from A to B, without kind of needing to worry about kind of the fee for that. A lot of use cases are priced out, basically, or just uneconomical, if you don't have that. And then so that actually opens up, the kind of target use case, quite a bit. We'll have confidential payments, that are, both, privacy preserving, and don't have regulatory issues, basically. Like you do want to like toe the line, in a way, right? But like you don't want to just become, a money laundering tool. I think that's an outcome that none of us are interested in any capacity. We have native support for custom gas tokens, and then so I think that's kind of a massive UX, unlock. um, Plasma is going to be deeply integrated with on and off ramps, but um, we've have kind of relationships with some of the largest on-off ramp, providers, and I think are going to like be, working on that extremely heavily, right? Because I think payments still, like, everyone still has kind of traditional banking, considerations, and so you do also need to make the like switch extremely easy, and I think that's critical. I think all of this is kind of really driven by kind of a focus on UX that like is not just geared towards kind of the average crypto degen, even though like we welcome, them. Obviously, I would kind of count myself as one of those, but I think for like truly kind of going the next step, I think you need to make this very palatable to a very wide range of users, and I think, that very much kind of informs how we think about what we're building.
I think if I can add also, it's just like, you're not compromising any of the kind of core functionality as well, right? Like um, you're not taking the broad-based approach of, I mean, this is also why you're an opinionated, stablecoin, purposeful stablecoin chain, right? Like you're not trying to fit the whole party under the tent, in a way. And I think that part really sticks out, right? It's like your core features, but I mean, it's ironic, right? Like something Paul mentioned earlier, right? Where it, if an insane amount of block space is just consumed by one application, and in most cases it's literally just Tether, um, then you should really start parameterizing around that one, singular application in a way, right? And building out only for that singular application in terms of throughput, right? If I go to a bank, right, and like my bank is like, obviously trying to offer me services of varying varieties, right? But like at the same time, like I don't need my bank to be like my grocer too, right? Like I don't need my bank to, do my taxes, and that would be nice actually, but or like give me a haircut or whatnot, right? So I think that's kind of this weird stance that we take as an industry where where there's very clear PMF for one specific use case in crypto. Why are we not building around this? And why why is this not getting a real kind of glance? And I think we're starting to see this emerge, right? I think Plasma is kind of the first one that's come to market on this, but we're starting to see this theme and this aha moment kind of emerge for a lot of investors and builders across the space. Just by virtue of being an investor in Plasma, the amount of inbound I get from like people that want to build on the chain or have this all of a sudden kind of light bulb moment of, hey, what if I built this on top? What if I did this? What if I was not constrained by like just the EVM or just a general purpose blockchain, right? That's when things start getting a lot more interesting. And really the ethos of crypto, and this is why I was really interested in this kind of conversation, is it really does go around the money first, right? So I think this is also kind of the core focus, which is how do you redefine, how do you change the money in the best way possible instead of like rehypothecating 6 different forms of leverage, right? Which is something Paul and I know all too well, but at the same time is not necessarily
I've done my fair share of rehypothecation for sure.
right. So,
Yes.
but it's not necessarily the interesting thing for a lot of people, right?
Yeah, that makes sense. Paul, to continue on the hot stuff, I wanted to ask about hot stuff. Nowadays, I see many hot stuff inspired consensus protocols, consensus mechanisms. Why is this the case? First of all, like from your end, why do you think that's the case? And secondly, what are you guys changing that is unique specifically for Plasma?
Yeah. I mean, odd stuff and kind of in general BFT based consensus, it just has advantages, right? I mean, it's fast, it's cheap. You have deterministic finality, which you kind of need, right? Like you can't do payment flow and have kind of probabilistic finality, even if you have like 18 nines, like if a transaction is final, it needs to be final. And so I think it's kind of the clearest kind of framework to use on the consensus side of things. For that, I think that's also why a lot of people kind of choose those BFT based consensus mechanisms, because they work, they're scalable, they're pretty battle tested at this point, and so you just have kind of a high degree of confidence in this kind of actually achieving what you set out to achieve. For us on the consensus side of things, obviously the kind of free stablecoin transfers introduced quite a bit of complexity on our end to actually handle, especially given that like if you have kind of a super naive implementation of this, then you just open yourself up to like just get spammed and then taken down basically like 7 seconds after launching a chain. And so you do need some kind of some complexity
Yeah.
around that, basically. And I think for us, like we've kind of made a couple of small changes to just kind of I mean, basically there is no like super standard hot stuff implementation, right? But like there's no like one this is fast hot stuff and you just copy it, right? I mean, it's basically a paper and a concept, and so by its nature, it's kind of custom because you kind of take the core concepts and then build the implementation yourself. And I'm technical enough to be dangerous. I'm not technical enough to kind of chat about like deep changes to fast hot stuff consensus mechanisms. But like basically consensus has to enable the feature set that we kind of just discussed basically. And so I think all of the tech is not a means like in and of itself, but I think it's very much kind of it's a tool to kind of actually achieve what we set out to achieve. And I think you don't want to kind of, I think there's a lot of cases in crypto, right? And a lot of very sharp people who kind of build stuff because it sounds very cool on the technical side of things. I think for us, we're very much, and we're quite practical on that side. We're like, really like, this is like what we are pretty opinionated on kind of a very good product looks like. And these are kind of the tools we need to actually get there. But I think the tools aren't the end goal, but the result is the end goal, basically.
What's up, guys? Today we're joined by Antonio from dYdX. Antonio, thank you so much for coming on again.
Thank you for having me.
Before we get started, what have you guys been working on since the last time we chatted? It's been about 2 months, 3 months maybe.
Yeah, so I think it's been a couple months now. Things have been progressing. We've been continuing on the main focus, I believe I mentioned at that point in time, which was really just making dYdX the best quality product, the best place to trade perps in DeFi. So there's a couple different aspects of that. We've been really focused on things like performance, reliability, making sure dYdX is fully featured, making sure dYdX has best in class liquidity, and a number of other projects around that.
Perfect. I want to get a bit into liquidity. How do you, from the protocol side, think of attracting liquidity on the platform?
Yeah, well, there's really two aspects of it now on dYdX. So dYdX is an order book based platform. So we work pretty closely with a wide array of market makers. And this is something where I think dYdX has been strong for a while now. We've had relationships with pretty much all the top market makers that are market making within DeFi, and most of them do trade on dYdX. And really, it's something where liquidity builds as in kind of a lockstep function in terms of how much liquidity you have and then how much volume the users are putting through as well. And obviously, we're seeing for most places in the space now a reduction in volume across the board for all of crypto as prices have decreased. But actually, the liquidity on dYdX has been improving over this time. So we made it a huge point of emphasis in the second half of last year to improve liquidity. And that took two forms: just building a lot of features, a lot of performance for the market makers themselves. And then the second thing that we built, which I believe we dove into on the last podcast, is a new product called the Megavault. And what the Megavault is just an automated market maker that will market make on the long tail of assets on dYdX. So it offers liquidity on pretty much all the assets, but the primary assets that are traded on dYdX are best served through order books. And then the long tail assets, that's where it's a bit harder to actually find liquidity. And dYdX has really built best in class liquidity for a lot of these markets now through the Megavault.
Perfect. You mentioned that you guys have been working on improving performance. What does that look like? And has there been a material change over the past few months?
Yeah, so it takes two forms. I'd say that the first piece is raw performance, just in terms of things like the throughput of the chain, what is the latency you can expect while trading on dYdX, just making sure that there's consistency on the order book and everything that happens. And then the second half is reliability. In the second half of last year, we made a lot of improvements to performance overall. And then more recently, we've been focused more on reliability. And the biggest piece of this actually is less so on the core blockchain itself. And there's two main components to what goes on behind the scenes. There's the core dYdX chain, and then there's a product called the indexer, which kind of is like an Infura type product, if you're familiar with that, where it takes the data that's coming off of the blockchain and serves it to the end users in a digestible format. And the indexer was actually the thing that had more reliability issues. And that's been the big point of emphasis recently. And the reliability there has improved quite a lot.
Perfect. I think about performance. I think over the past year, crypto's changed quite a bit in that we're taking more trade-offs between performance and decentralization. What are your thoughts on this? And what is the dYdX thoughts on this, the platform's position?
Yeah, it's a core thing that I think about a lot. And I think something that's just intrinsic to DeFi overall. Obviously, there is a trade-off between performance and decentralization. And we've seen different competitors take different points along that trade-off. And really the thing that you're trying to find most is two things. First of all, what do the users want? And there may be different types of products that may require different amounts of decentralization versus performance. Perpetuals trading is something that requires an extremely high amount of performance. Just to give a sense, on the dYdX chain right now, there's over 5,000 orders placed per second. It's like literally more performance on dYdX chain and probably Hyperliquid as well than you see on basically any other blockchain, kind of Solana included. So it's like just this one product is using the throughputs of like all other blockchains combined, more or less. So that's the thing that we've built. I think Hyperliquid has done a good job there as well, building a performant product. And then the second thing that you really have to look at, in addition to what do the users actually want, is what is most aligned with the protocol's values and with the ecosystem's values, just in terms of what they care about long term. And decentralization is always something that has been really core to dYdX. And we've had a long history of building in a decentralized way in the space. dYdX has gotten more and more and more decentralized over time. And it's just something that is quite core. And so you really want to think about it in two forms, both finding the optimal point on this performance decentralization curve. And that's still something that we're looking at. And then the second thing that you want to do is optimize and just improve the raw amount of performance and decentralization that you can get at your chosen point along the curve. So I think this is still something that's evolving. We have made quite a lot of improvements here, as I was mentioning, to the performance overall. And I think in ways that really have not sacrificed the level of decentralization that we have either. And we'll see how far that takes us. But it's kind of this thing where you launch a new blockchain and it's just hard. Like the thing won't work perfectly right out of the box almost always. And then you really see what your use case looks like, and you zero in on a lot of optimizations that make really big improvements, potentially even 5 to 10x plus type improvements in the next year or two after you launch the thing, which is really the phase that we're in now.
I want to chat about the zero fees because I've heard, many people brought this up to me and said, how are they dealing with spam? Is the first question. And the second question is, how are they going to end up making money? Now, over the past year, people have finally realized that these chains and these protocols, they need to make a little bit of money. And how are you guys going to do that? As far as I understand, it's not all transactions that are zero fees. It's just like payments, but maybe you can chat a bit more about that.
Yeah. So it's transfers of USDT or USDT zero, and so it's a kind of that select kind of category of transaction, basically. The spam is kind of really the main technical challenge, and because like I said, like if you have like the most kind of naive implementation of this, then you just suffer from liveness issues, basically, like inevitably, and so we'll likely enforce minimum balances at the beginning, which is kind of the most kind of it's practical. It makes sense. It's not massively complex. It's not the ideal solution, and it's also not kind of the end solution. You then have kind of way more kind of complex approaches that kind of also kind of deeply intertwine with the consensus side of things, where you kind of segment transactions into kind of being real. You can have some sort of like especially around like the kind of very high flow generators, you probably have some sort of whitelisting functionality to kind of prevent just like any address being able to like spend 17 million transactions in 1 second, kind of clog up your entire chain. I think you kind of have hybrid approaches between those. We'll start with kind of the simplest approach, but then kind of pretty quickly iterate to kind of more complex and kind of more fit for purpose solutions, basically. In terms of how we make money, very good point. I think you do need to kind of win flow and volume on the payment side. I think that's absolutely critical. I think it's very much real that you do price out kind of certain use cases where Tron isn't even that cheap anymore, right? I mean, it costs you $3 to do an ERC20 transfer on Tron, which is actually kind of insane, right? Like Tron has, in the last couple of weeks at least, kind of consistently actually been more expensive than Ethereum, mostly driven by just no one using Ethereum anymore. But that's a kind of a different topic. You do have a kind of lot of transactions that like aren't just the simplest stablecoin transfers. I think you do have a lot of demand on just the transfer side, but I think that inevitably kind of leads to demand for like more complexity as well. And there you just have kind of the normal gas fee concept, right? And so it's still going to be like revenue generating on the chain level, and then so kind of meaningfully kind of actually drive like specifically validator revenue, right? Because like you do need validators to make money, because we'll launch with a permission validator set most likely at the beginning, but then pretty quickly open that up, so anyone can kind of permissionlessly run a validator, and that only makes sense if it's economical to run one. So if you lose money on running a validator, then you just won't. And I think that contradicts what we kind of set out to achieve, which is kind of having a very large set of validators, because like I think this has to be decentralized and kind of in the hands of kind of anyone who's interested in having it.
That makes sense. So here you kind of brought this up as well, Paul. You also just brought it up. How do you guys, so it's not just going to be an issuance and settlement chain. You want, I mean, the majority of the block space will likely be Tether or like USDT dominated, but you still want other applications
That's
building
true
on
for a
top
lot
of
of chains.
Yes,
Yes.
yes. So that's, but you still want other applications to launch on it. You want this to be generalized, but also like with a stablecoin focus initially, or for the
I
time
mean, look,
being.
it's going to be permissionless to build on Plasma, right? And so like we're never like I think permission chains have a horrific track record, and I think that is not a coincidence, right? And so like and we're very opinionated in terms of like what we think is valuable to kind of a stablecoin ecosystem, and like I think that's fine to be opinionated on. In the end, anyone can build whatever they want to, right? And like so like we won't kind of permission the chain, because I think that is like, why are you building a blockchain if it's permissioned? I've not heard a good response to that question, and so I'm not keen to just like build a slow and annoying to work with database. Like it does have to be permissioned, but it's very focused on kind of anything that is stablecoin adjacent and kind of actually in service of making the core mission better, more usable. And I think that has to include lending functionalities. It has to include obviously kind of swapping of one stablecoin to the other. That has to yield has to play a role, right? Because like you do have kind of just savings product on products on chain, and you do have like all of those kind of categories. And like I'm like, this is not an exhaustive list, that are kind of very much in service of what we set out to do, and then so we're kind of very actively fostering that.
Yeah, there's not a world where you're I mean, you could launch an NFT marketplace on Plasma, but like, would you want to? Probably not, right? But I think that's kind of the idea, right? Like, again, if you think about the way that uh, Ethereum broadly, but Solana and the rest of these kind of generalized blockchains have kind of gone, and now to like more specific apps in particular, right? Like Hyperliquid, right? I think you're seeing more and more of this, like, why am I trying to like build a chain that's trying to fit like 70 different standards instead of just focusing on the one thing that I actually care about if I'm like building a sick product. Um, I think that's kind of the vision, right? So it's not to say like the only thing that like Plasma is going to focus on is payments, right? That's probably the case at the outset, but the idea being that like anything adjacent to stablecoins is kind of an interesting kind of space to be in. And I think also when you look at the stablecoin market broadly, you're really seeing a massive bifurcation between like what we see at like the, let's just say, native level, or even like peripheries of the native level of crypto, right? And people just not even knowing like what they're transacting with, outside of knowing that like there's some representation of a dollar, and that I can have it like digitally and anywhere, right? They couldn't care less like what actually is happening within reason. They just want to know that they have some dollars or some safety or some sort of value somewhere that they can like liquidly withdraw and like not pay an insane fee, basically, right? Um, so I think to that universe of people, that's like where this product becomes like materially more interesting, right? Obviously, the implication, and also like between Paul and the rest of the team and at Plasma and even the investors, is that there will be more of a component to bridge across the rest of crypto to these people, right? Like you said, having sort of money market having the opportunity to do more with stablecoins than just transfers.
Yeah, I think that makes sense. We've brought this up a few times. Tron and Ethereum are the leaders at this point. I'd say Tron more so, especially for payments. I know most of dollar DeFi activities on Ethereum. First of all, how will you compete with Tron? Because as far as I understand, they just have a massive network at this point, and it's very, very difficult to kick them off. And secondly, we're now getting a few more competitors. I feel like Base and USDC's relationship is interesting. On top of that, we have One Money, Athena, I think Cap Money's on Mega Eve. There's a lot of new stablecoin focused protocols or chains launching.
Codex, yeah.
What's the? I guess.
Yeah, I think I think those are two very, very separate questions to an extent. I think the era of Tron is going to end one way or another. I think especially kind of with these kind of now, I think increasingly kind of non-peer-to-peer use cases. I think you just have kind of a very, very large universe of use cases that like Tron just isn't built for. And I mean it's pretty centralized, right? I mean you have 27 validators. His Excellency Justin Sun, I think, is running a non-zero amount of them, and so I think you do kind of have just risk of holding a lot of inventory on Tron, and so I think it's kind of showing cracks to an extent. Tron is incredibly good at kind of the local ground game. And like I've spent time in these places where like you go to the kiosk in El Salvador, and you can pay with USDT on Tron. That's kind of the standard use case, and so they are like very, very deeply entrenched, and like genuine respect for kind of how they executed all of this. I think in the end, things happen slowly and then all at once, and I think a kind of a similar thing is going to happen on the Tron side of things. But I think it kind of very much had its time and place, and I think that is in the past, and so I think you can win against them. It also requires kind of local ground game, and it especially requires kind of deep integrations to existing kind of infrastructure on the payment stack, basically. But I think it kind of inevitably happens, basically. In terms of other chains, there's a lot of very good teams building this. I think most of them kind of have different approaches than we do, and I think that's fine. I think all of this can kind of coexist. I think One Money guys are doing interesting stuff. Codex is doing interesting stuff. Athena is doing very interesting stuff. We actually work with them pretty closely, and so we'll also have Athena on Plasma,
Cool.
and I think like this can very much coexist. Like I don't think we're super competitive with them specifically. I think for us, we're kind of very much. I think we're taking a pretty opinionated and different approach to most of those kind of products, where like we're very much not kind of just building kind of a developer platform on the top of existing infrastructure, but like we're not just kind of an OP stack kind of out of the box chain, which but like don't even mean that negatively. I think that's probably a fair choice, but we're kind of very much like rebuilding the infrastructure layer underneath that itself, and with one specific goal, which is like getting to stablecoin flows. And that means, I mean, as we discussed, kind of means custom consensus, means custom execution layer, means deep vertical integration into kind of actual existing financial infrastructure. And so I think it's not about like wrapping the existing experience into better tooling, but it's very much kind of rethinking the very base layer. And I think that is a somewhat unique approach that I think most of those examples don't really have, which is fine and can work, and kind of I think can also coexist.
I think there's one thing that you said in particular when we talked about Tron earlier, right? It's like Tron was not purpose built for stablecoin transfers, right? Tron is very much kind of an ETH clone in a way, right? Even the naming convention TRC20. But I think that's like the key point here, right? Which is, if you look at like the bifurcation of, let's just say, most of the tether market, right? It's between like Ethereum and Tron, and a lot of this really, especially on the Tron side, is just for simple transfers, and it's very much a network effect kind of
Yep.
game. It's not so much that it's necessarily the best technology that's being kind of built out there, right? And I think people haven't really felt the need to necessarily rethink this until recently, when stablecoin transfers are getting substantially more expensive. And obviously, the dollar velocity that's kind of increasing on stables is moving exponentially at this point, right? So I think this is kind of the core thesis, which is, you know, we as an industry are rethinking, what are we actually doing in terms of building around a better system than the one we built, let's just say 9 years ago, right? And how should we rethink, core purposes, right? Like, it'd be a very different ball game if the considerations between uh applications were more evenly split, but it's very obvious that stablecoins, in terms of transfers in particular, are like, the overwhelming majority of the use case, at least in terms of directional proportion of mind share.
That makes sense. Paul, you guys are gonna have Athena also on Plasma.
Yes.
How many more stablecoins? Anybody?
I think Athena is very much complementary to
Yeah.
USDT. I think like people talk about stablecoins as kind of one kind of monolithic category, and I think that's kind of mostly the wrong way of thinking about it. Where I think stablecoins actually kind of split into a bunch of like subcategories. Like you're even seeing it from like the both Stable Act and Genius Act, and where like you have this kind of very clear kind of bifurcation into like payment stablecoins basically, and then kind of everything else. USDT, in my opinion, is the absolute apex payment stablecoin. I think there's absolutely no second best, one singular chair, etc. But you then have kind of different like, I think USDE, for example, is a very different product than USDT. Actually, on the surface, it looks like it's kind of like competitive and the same product. It isn't. One of them is a savings account type product, and the other one is kind of very much kind of just kind of a payment stablecoin. And then so we're very keen to kind of work with great teams, and like we are working with a lot of great teams who are kind of building in and around stablecoins. Some of them have kind of their own stablecoin products, some of them don't. But I don't kind of view that as massively competitive to USDT.
I qualify that also by saying, like, I think even within the category of stablecoins, right? Like, everyone is coming to market with their own stablecoin variation, right? But I think the reality is, it's like, outside of these two core products, which is just like, you know, digital dollars and digital savings account, like, there really isn't, a good need for 50 different versions of USD, right? And I think, something that, like, is very important to also understand in terms of, the product decision for Plasma picking USDT is also, what game are you really trying to solve, right? Are you trying to solve, domestic issues within the United States in terms of like dollar transfers? Like, ultimately not, right? Because the system works pretty well. Like, if you're a bank, you don't need to be able to create a better sort of USD kind of transfer mechanism that already exists. You can do it for free, right? This is quite literally the master account kind of direction. This is something good for us to talk with Felix on on the money sorry, on the margin podcast. But I think it's more so the game of really trying to figure out, well, this entire universe of non-American dollars, non-American uh, you know money transfer that exists, how does that basically get changed, and how does it go from fiat systems, right? Of, this is a really incredible one, but this is one that's like very personal, which is like the Hawala system, which is very commonly used in the MENA region. It's like, I send money to some guy credits some other guy on the other end and takes like a 5% spread, right? Like, this is the most archaic like form of money transfer possible, right? I think that's essentially the goal and focus, as opposed to saying like, hey, we have 15 different versions of USD that need to like basically, service American bank accounts or, replace Venmo or whatever it is, right? Like that system works pretty well as it is, right? This is also why you don't really see, there's it's a very big difference in terms of, the stable coin kind of growth between different issuers in a way, right? This is why some work and some don't, and why the network effects are so strong for, our favorite green stablecoin.
Very good. We're getting a bit spicy, but yeah, I agree with you completely. Especially on that non-US payment side, I find that sometimes most of the team is American, and it's very difficult to explain to them that, like, I come from a country where there's horrible inflation. We care about the US dollar, and we want that, and I want to be able to hold that, send that relatively easily, and be able to pull it out whenever I can. And like you said, that's been the growth that you've seen on USDT, on Tether, and I guess that's why Tron has also done very, very well, because they managed to capture that side. I have two more questions. One of them is why Bitcoin? Plasma is related to Bitcoin in that it is using it for security. Why did you guys decide on doing Bitcoin and not something else?
I think if you take the approach that stablecoin rails at massive scale need to be kind of credibly neutral, decentralized, and kind of have kind of the strongest security assumptions, you can't really not build it on Bitcoin. Is my view. I mean, it's very much kind of the most lindy, the most robust blockchain. Where there's no Bitcoin reorging, and like it is kind of the one apex kind of blockchain in my view. It happens to be very limited in what you can actually do on it, right? Which is like why Plasma needs to exist, basically. If kind of Bitcoin had a very, very kind of wide range of capabilities, and we think it's probably a good thing for Bitcoin that it doesn't, then Plasma wouldn't need to exist. But it doesn't, and so you kind of need to build on top of it. And our strong conviction is I think we can, if you optimize for having kind of a true decentralized and safe product, then there's no way around Bitcoin.
That makes sense. So here you brought this up a few times, and I want to really, really talk about it. There's been my fear with the regulation is that now we're gonna get, like you said, 15 to 20 different stablecoins per bank, and then already I feel like the stablecoin ecosystem is a bit too, I guess, wide. There's just way too many of them. It's not easily fungible. You're taking on different risks with different ones. To both of you guys, how do you see that space consolidate? And yeah, that's it. How do you see that space evolve and consolidate? What do you think? What would you bet like the next 2 years will look like?
Next two gets very complicated because I think that you're right. You're going to see more issuance of new stablecoins than less, right? It's going to be like worse before it gets better kind of thing. Um, but I think the world and everyone knows in their bones, right? Like, so this is the kind of like calculus. This is going to be a bit of a long-winded answer, so I'm going to preface this, but this is going to be the kind of calculus for most financial institutions. It's like, oh my God, Tether makes X amount of dollars. Why don't we do this? We have a balance sheet. We could do this, right? And we could take it down. But again, it goes back to the original point, which is they don't understand why Tether is the best, stablecoin. That Tether does not service, if you think about it from the, yield perspective, which a lot of stablecoins go and try to attract, right? Nobody cares to get the yield, right? Billions of dollars. There's since the election, there's been something like $30 billion in new stablecoin issuance on Tether, right? That's another $30 billion that's saying, I don't care about the yield. Just give me the best, most liquid product that is always available, and I can have it in my local jurisdiction. And people will forego whatever yield they can get on that, same amount of dollars, right? So that's kind of point number one, right? People are the stablecoin issuers of today, especially the new ones that are kind of popping up. They don't really understand the fundamental reason why Tether is winning, which is Tether is much more of a replacement of the Eurodollar system broadly than it is anything else, right? It is creating the ability to have dollars offshore while the American government is very happy, right? Subliminally, without actually needing to kind of go in and intervene. And then the other, to take the other side of the argument, right, which is, okay, then let's look at the domestic stablecoin issuer in Circle, right? Circle business is fundamentally different. Like after we saw the prospectus for the S1, we realized very quickly as an industry, I mean, we knew this, right? But, as an industry that Circle's not a great business, right? It's not like Tether. These two are not the same at all, right? Number one, they give away almost the overwhelming majority of their revenue for their largest partner, which is Coinbase. And they'll have to do this for every single new kind of, fintech company or bank that they want to work with, because obviously you did it for one, you can do it for all of the rest, right? If it's Coinbase that has the bargaining chips, then Binance is going to do the same thing, right? And then so on and so forth. So, Circle's game is very much flood the market with the supply of USDC and pray to God that, like, once the velocity gets to $1 trillion plus, right, that then maybe it'll be, the law of large numbers gets so insane that, like, you'll still make some money. Funny enough, they pulled their IPO a few days ago. Obviously, probably more related to tariffs than anything else, but still, it wasn't met with a ton of positive reception. Whereas Tether, a private company that's is very much moving in the right direction and kind of hitting a lot of traction within the U.S., right? And you saw this with the outcry of kind of the Circle team really pushing Tether to kind of get eliminated from any sort of stablecoin regulation by banning foreign issuers. America is not dumb, thankfully, as a legislative body, broadly speaking. And really, they understand that you need a sort of offshore dollar system to exist. You just want to bring them into the fold just enough to where you have purview, but you don't want to kind of fully meddle in that system. This is also why Tether's existed for so long, right? You're not going to have $100 billion plus stablecoin exist or dollar system exists without obviously the government knowing about its existence, right? I think these two things are really critical in terms of the kind of ongoing push, and I think Paolo gave an interview, I think, to Forbes. I don't know when it was, but the article released today, right, in which he highlights it's like he could have a bunch of, and I really appreciate his insights because obviously he's running the best one, but he could have a bunch of different opinions. He could give out the yield, he could do this and that. And, I'm sure he's thought about all of these different approaches, but he kind of is always harped the same thing, which is people just want stability in their dollars, right? People want to know that my, dollar will exist tomorrow in the same way that it existed today, and that it's going to be good anywhere in the world that I go and want, and can transact in that, right? They don't want a store of value. That's what Bitcoin is for, right? In terms of, having like a sort of hedge against inflation. They want, digital dollars so they can go and spend that money basically, right? So I think this is the kind of fine line that people like they get too cute with it. They try to put everything into one package, right? But they don't understand fundamentally the reason why Tether, is doing so well and why it's kind of the only game in town in a way, and will probably be the largest winner across the next number of years, right? With really, the competitors kind of dying out, fundamentally hinges on the fact that you're not going to have 50 editions of the same dollar, right? You're not going to have 50 different. This is why banks haven't ever issued their own currency. In the past, they actually did this. So this more than 100 years ago in the U.S., different banks issued their own currency until the practice was standardized across the board, right? So people realized very quickly that it was a bad idea to have different people issuing different types of dollars, right? The same thing will happen here. That's going to fundamentally, happen. What does that look like? Does it look like Tether plus government or something like this? Maybe, but it's going to be very hard to replace the global source of USDT. Very long-winded answer, but that's kind of my push for this.
In full agreement, by the way, with all of those points.
Paul, what about you? How do you see that space apart from what Zaheer mentioned? Shay.
I fully agree. I mean, I think stablecoins are kind of massive network effect in businesses. As kind of Zaheer mentioned, like you need to know for a fact that what I'm holding here as kind of a digital representation of a dollar is actually kind of universally accepted. And like I don't want to like go around with my JPM dollars and my Fidelity dollars and my Franklin Templeton dollars, and I think all of those probably make sense in isolation, right? But like you do have kind of that very strong preference, but like I would just like to hold the most liquid representation of a tokenized US dollar product, and you have one choice in that category, and that is USDT. And so I think I think I'm actually like a lot of people are kind of very very negative on like we should stop like launching new stablecoins. I think like experimentation is good. I think like it's probably a net good that like as an industry like try different things. Some of them probably work, some of them don't. I think like we should welcome that regardless. Um, I don't think any of that is actually too threatening for USDT. Interestingly enough, I think it is pretty threatening to USDC, right? But like I mean, as kind of Zaheer outlined, but I think USDT is kind of the international euro dollar, and then USDC is kind of the domestic USD product. I think Fidelity and Franklin Templeton and JPM, like all like those types of entities, kind of launching US dollar products, I think that massively threatens USDC.
Yeah.
It doesn't threaten USDT at all because they're just fundamentally different products. And then so I think if I'm in Circle shoes, I'm really I'm 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 really not too keen on kind of having 1,000 more stablecoins coming out of the US from like large financial institutions in the US. I would hate to see that. If I'm USDT, like I don't think it matters basically. It's interesting, it's good experimentation, and I think that there's likely going to be kind of lessons learned in what works and what doesn't.
I think if I can qualify that also, like, um, you know, there's some game theory also around Circle kind of pushing their S1 now in particular, in terms of getting an IPO out, because I think ultimately they probably see the writing on the wall that, other people are going to try to play this gambit as well. One thing that like we kept mentioning is this idea that, you have stability around the world if you have USDT, right? But it really is a very fundamental point that like when you go to a kiosk in Istanbul, right, in the Grand Bazaar or in Dubai or wherever, it's like you only see two things there: buy Bitcoin, USDT. There's nothing else. And until that stops being the case, until you start seeing USDC, pop up tents in these different places and like it's more widely used and more widely adopted, like it's not even a conversation, right? It's not, and that goes on for every other stablecoin, right? This is not so much that it's Circle hate or USDC hate as it is, what game are you really trying to play, right? Like, are we trying to recreate Venmo or are we trying to recreate the Eurodollar system, right? That's kind of the bifurcation of those
Funny
two, and
enough,
I think
I think the TAM for euro dollars is like probably 2, maybe 3 orders of magnitude larger than the TAM for kind of just domestic USD products, right? And then so I think you also just have like a massive delta in kind of how large this market actually is.
right. And I think, when you think about Plasma in the context of this, right? We have $240 billion of stablecoin, issuance in total, right? And outstanding supply. 150 plus billion of that is in Tether's hands, right? Um, Even that is a kind of tiny drop in the bucket of where global liquidity kind of goes to. The tagline for all the plasma guys is always trillion. So this is the coin term that has been used across the board for all the plasma, people in the ecosystem, the community, whatever you want to call it. But I think it's a very salient one line, one word kind of thing, which is what happens when multiple trillions of dollars of value kind of come online on chain, where people find out that this is the best form of, censorship resistant, you know, money that you can kind of create in terms of USD stability. What does that look like? Then you'll start dwarfing $200 billion in stablecoin volume, and I think that's the broad focus. And you hear this a lot, and I hear this a lot on the investment side, more than anything, of products coming to market, trying to be like, we're here for the next 100 million users, right? But fully seriously, this is kind of the goal, right? What happens when the one product in crypto that is consistently growing, even in the face of tariffs or bad market or whatever, there's still more stablecoin issuance every single day. What happens when that market, becomes 10x the magnitude, basically, right? And if anything, you're seeing new stablecoin issuers come to market. This is, a feather in the cap of companies like, Tether and Circle, right? This is people acknowledging that this is a great business, this is a great product, and like we should be competing in this, right? So competition is good in that lens as well. But I think people, broadly, the takeaway from this podcast or kind of the vision for Plasma or stablecoins in general should always be, what happens when so much more of my life is actually using, stable coins if I'm basically outside of the US. That is kind of the takeaway, and that's what you can start dreaming up in terms of scenarios of what, the future of Plasma or Tether can kind of look like.
Perfect. Guys, we're gonna end it up, but before we do that, Paul, where should people go to read more about Plasma and learn more about Plasma?
To plasma.to or to docs.plasma.to. That's kind of the kind of the most detailed kind of content we have out there. We're pretty active on Twitter at plasmafdn. And I'm Paulie Punt on Twitter. And then so feel free to yell at me in my DMs there.
Very good. Zaheer,
Yeah,
what about you?
We'll leak Paul's PSN and his carding username and whatnot, but
Please do, yes.
I'm at Split Capital on Twitter. Feel free to reach out if you have anything interesting on the stablecoin side or otherwise. We've been hosting like a bunch of different kind of roundtables for stablecoin related stuff. I think it's also funny. It's like we talk about the universe of stablecoins. Like we're finally getting to the point where regulation is starting to matter in crypto. So it's also interesting for all the other implications of where crypto goes from here in the US and the West in general.
Yeah. And I think actually, I mean, not to kind of open up a kind of more major point here, I think like stablecoin regulation is basically downstream from all of crypto. Well, like stablecoins are so deeply entrenched in kind of how the entire kind of crypto system operates, right? And so I don't think anyone can ignore stablecoin regulation. And because like it touches everyone, even if you have nothing to do with stablecoins, because they
Right.
just run the crypto economy. And so that's also why, I mean, I was actually kind of keen to kind of talk about some of the regulatory capture attempts from Circle, but maybe that's kind of for a future discussion. I think all of that is incredibly bad for crypto, and I think we need to ensure that like you have offshore issuers that are kind of capable of like continuing to kind of be this massive net benefit.
No, I completely agree. We had DAS, which is one of our conferences in New York, maybe a month ago. And that was what everybody was talking about, the Stables Act and the Genius Act. But maybe like 60-70% of the conversations that I was in, people were talking about that. And they were also talking about the attempted regulatory capture, Paul, as you mentioned. Obviously, it hasn't worked out as far as I understand. I'm not gonna LARP as
but I think as a crypto industry, I think like it's upon us to like take a very clear stance on this. I think this like no matter what you do in crypto, I think this is extremely relevant for everyone, and so I think we should be ensuring kind of open and safe access to USD denominated kind of crypto markets, and I think that is in everyone's interest. And I think the kind of reg capture is very much against everyone's interest. It's kind of similar to kind of the AI model of regulation debate. Not to like again kind of go on a massive tangent, but I think you also want open source AI models to exist, and you don't want to like regulate them to death and just kind of have everything in like one or two centralized hands. And then I think the same thing very much applies to crypto.
Yeah, that makes sense.
Yeah.
Go ahead, Zaheer.
I was going to say the last company that tried like some nasty sort of regulatory capture, that one was even more egregious with FTX against Binance and other offshore exchanges. So it's just always like bad karma to do these things in my opinion. But it's
I like that Paulo went to DC and went to New York, and he had like a very sharp suit, and he took pictures in front of like all of the also
standing
found
on
it
business.
funny when also found it funny when he said we don't have to IPO the other week, like in a tweet, which was okay, guys. Thank you so much for coming on. This was fantastic.
Thank you.
Thanks for having us.